What's up, YouTube? Welcome back to Not Dumb Money. In today's video, I'll talk about why I own Microsoft stock. That's what you told me you wanted on Instagram, and your wish is my command. This video will be a little different from my previous videos on stocks, in that I won't really get into Microsoft's history. I want to spend more time running you through some basic analysis instead. But first, if you're not a subscriber, please show me some love and subscribe. Don't forget to hit that notifications bell so you don't miss out on future videos. Do it! That'd be awesome. And if you're already a subscriber, you are just the coolest person in the world. All right, so Microsoft is well known for the Windows operating system in the Microsoft Office suite of applications. That's how they started, but today they offer so much more. They have other business software such as Windows Server, SQL Server, Microsoft Dynamics, and SharePoint. They're in the cloud business with Microsoft Azure. They're also in the hardware business with their Surface tablets, laptops, desktops, and more recently, phones. They're also in the gaming industry with the Xbox and Microsoft xCloud. Their current CEO, Satya Nadella, is Microsoft's third CEO in their 40-year history, and ever since he took over the top job in 2014, he's pivoted Microsoft towards high-value commercial and cloud applications. Over the past few years, Microsoft has doubled its market share in the cloud infrastructure business. Today, it's the second largest cloud services provider behind Amazon Web Services. They have plenty of room to grow in cloud and have a distinct advantage over Amazon with their software stack. In gaming, their new Xbox Series X will be released later this year, and they just confirmed that it'll launch alongside an affordable Xbox S Series, priced at $299. It should create for some interesting competition with Sony in their upcoming PlayStation 5. All in all, Microsoft's products are aimed at the enterprise efficiency and online collaboration, and we all know how important this has become recently. In their most recent earnings, they surpassed analyst expectations on both sales and earnings. They generated $38 billion in revenue last quarter. Year on year, sales are up 13% and earnings are up 7%. Revenue from their intelligent cloud segment rose 17%. Their more personal computing segment, which includes PC software, Xbox games, and Surface computers, was up 14%. Their mature productivity and business process segment, which includes Office, Dynamics, and LinkedIn, grew 6%. Now, let's get into some fundamental analysis. Please keep in mind that the numbers I'm about to present are accurate as of September 13, 2020. The peer set for this analysis will include Adobe, SAP, Oracle, Apple, and Amazon. I would normally include Salesforce, but I feel like it's an outlier. Salesforce has a PE ratio of 623 and a forward PE ratio of 65. Their historical earnings growth is lower than Microsoft's, and their earnings growth forecast is just a little higher than Microsoft's. Using Salesforce in the peer set will raise the median and just contribute to making Microsoft look like a bargain. I want to avoid that. Amazon's PE ratio is around 120, and their forward PE ratio is 71. But they have the historical and expected growth to back it up. Salesforce doesn't, so Amazon stays. Okay, here's my fundamental analysis checklist. Let's see where this takes us. I like to start with the PE ratio, so let's take a look. So, Microsoft has a PE ratio of 35.4. That's pretty much in line with the median of its peers. It's a good start, but their PE ratio is higher than Apple and Oracle, and a lot lower than Adobe and Amazon. Now let's try to understand why. Next up is the forward PE ratio. Microsoft's forward PE ratio is 27.8, which is lower than the median. Again, good. But Microsoft has a lower forward PE ratio than Adobe and Amazon, and a higher forward PE ratio than SAP and Oracle. I need to know why. So let's take a look at the price to earnings to growth, or PEG ratio. I mean, there's quite a wide range of PE and forward PE ratios. It's got to be down to growth, right? Well, what do you know? Microsoft's PEG ratio is well below the median. In fact, the only company with a lower PEG ratio is Oracle. So far, it's looking like Microsoft is undervalued compared to its peers. But the next ratio I want to look at is the PS ratio. Well, this doesn't look good. Microsoft has a very high PS ratio of 10.9. It's higher than the median of 5.9, and the only company with a higher PS ratio is Adobe. Why is that? It's probably because they have much higher profit margins. And they do. They have a profit margin of 31% compared to the peer median of 21%. In fact, they have the highest profit margin out of the entire peer set. Okay, so the PS ratio doesn't really bother me that much, especially given our findings for the PE, forward PE, and PEG ratios. Now let's take a look at historical earnings growth. Over the past 5 years, Microsoft's earnings grew at an average of 31%. That's way above the median growth rate of 13%. Their expected earnings for the next 5 years is also great at 15%, a little above the median of 12.5%. So everything we've talked about so far points towards good value in Microsoft stock. But let's go through the peer list one by one. Adobe has higher ratios across the board when compared to Microsoft. However, their profit margins are almost identical to those of Microsoft. Their expected earnings growth is similar too. Their ratios are probably much higher because Adobe had higher growth over the past 5 years, 62.7%, compared to Microsoft's 31%. But I think we need to look forward. And when we do look forward, it looks like Microsoft is undervalued when compared to Adobe. Next is SAP. SAP has lower forward PE and PS ratios when compared to Microsoft, but Microsoft has a lower PEG ratio, better profit margins, and demonstrated higher growth in the past, and is expected to grow at a higher rate in the future. With that in mind, and if we consider that they have the same PE ratio today, Microsoft looks undervalued when compared to SAP. Oracle. Now see, this one is interesting because Oracle, at first glance, looks like a bargain compared to Microsoft. Oracle has lower ratios across the board. But in this case, the PEG ratio is only marginally lower. After all, Oracle's earnings grew just 7% over the past 5 years compared to Microsoft's 31%. Microsoft is also expected to continue to grow at a much higher rate, and they have better profit margins. With that in mind, I think Microsoft and Oracle are both reasonably valued, but I personally see a lot more upside with Microsoft than Oracle. Next up is Apple. I actually own Apple stock, but there's a reason my position in Microsoft is larger than my position in Apple. Their PE and forward PE ratios are comparable, but Microsoft has a slightly lower PEG ratio. Microsoft has also had higher growth in the past and is expected to grow at a higher rate moving forward with better profit margins. So while I still see upside for Apple, I think there's more to come from Microsoft. I have another video that's focused on Apple. A link to that video should come up right now. Take a look if you're interested. There's a link to the video in the description as well. Last on the list is Amazon. I mean, there's actually not much to talk about here. Amazon's ratios, with the exception of the PS ratio, are much, much higher. That's because they've grown at an amazing rate of 115% over the past 5 years, and their future growth rate is expected to be more than double that of Microsoft's. The reality is, I also own Amazon stock, but they're very different bets. With Amazon, I'm betting on continued hypergrowth and expanding margins over time. Amazon's profit margins are just 4% compared to 31% for Microsoft. It's difficult to compare the two valuations, so I won't. Other than to say there's merit in both, and that is why I own stock in both companies. By the way, I talk about why I'm long Amazon in another one of my videos. You should see a link at the top of your screen. Check it out. I'll also leave a link to the video in the description. And side note, analysts covering Microsoft have target prices that range from $215 to $260, so I'm not the only one who thinks there's still some upside left. Okay. So, TikTok. What could that mean for Microsoft? News surfaced that the US government was looking to ban TikTok. As a way to appease the US government, TikTok owners ByteDance explored selling TikTok. President Trump acknowledged the negotiation between Microsoft and TikTok and said those talks can continue. He set a deadline for September 15th. A deal will probably cost Microsoft tens of billions of dollars. The Wall Street Journal is projecting revenues of $6 billion for TikTok in 2021. Reuters said that ByteDance's investors value TikTok at $50 billion. If the deal goes through, it creates a new and exciting segment for Microsoft. If the deal doesn't go through, Microsoft still has lots to fall back on. I'm bullish on Microsoft either way. And with that, we're done. Thank you so much for watching. Hey, what are your thoughts on Microsoft? Are you bullish? Bearish? Please let me know in the comments. And if you liked this video, please do me a huge favor and hit that like button and subscribe. Your support would be amazing. As always, it's been a pleasure. Much love. Peace.